Our studio in New York City, I'm Julie Hyman, that's Josh Lipton, this is Yahoo Finance Live, and here's what we're watching this afternoon. We're an hour away from the close on this first day of trading in 2024. Declines though across the board, tech stocks the hardest hit with the Nasdaq down nearly 2% on the day. We're going to look at the biggest movers of the day.
Plus, big changes for electric vehicle sales this year. Now only 13 models qualify for the full $7,500 tax credit. We look at the implications for the auto industry as both Tesla and Rivian report quarterly deliveries.
And our call of the day, Moderna, the S&P 500's worst performer last year, getting an upgrade to start 2024, and an optimistic shareholder letter from the CEO also driving sentiment on Wall Street. We've got the analyst behind that call later this hour. Let's get you up to speed on the market action right now. Pulling back to start the year here in 2024. And as I mentioned, it is tech very much that is leading the declines here. The Nasdaq off by more than 2%. The S&P 500 down 0.9%. The Dow off about 79 points. That is about a fifth of 1%. What we tend to see at the beginning of a new year is the rotation, right? You tend to see sometimes some of the best performers from the prior year go down, some of the worst performers get bought. So that's a little bit of what we're seeing today. Information technology, the worst group in the S&P 500, healthcare and energy catching a bid today.
All right, so let's stick with the Magnificent Seven here because we know they drove record market gains in 2023. And Wall Street optimistic the tech giants can keep that momentum going in the new year. According to estimates compiled by FactSet, the street is projecting the Magnificent Seven stocks will rise an average of 11% in the new year, with the exception of laggard Tesla. So as you mentioned, Julie, this is sort of that time of year. You rethink your portfolio maybe a bit. You think, you know what, do I stick with the winners, right? And certainly the Magnificent Seven winners in 2023. If you piled in 12 months ago, you're probably feeling pretty good and pretty smart right about now. And there were different reasons those stocks worked last year. You know, you could think about AI. Certainly these were companies that put so much time and effort and money into that tech, and they began to integrate that tech across their product portfolios. Another reason, obviously, some investors piled in because they thought they were defensive, right? They saw, you know, they were relatively predictable, strong moats, strong balance sheets. Warren Buffett likes some of them. He's a pretty smart guy. So now the question is, do you stick with that trade as we head into the new year?
Well, most strategists are sticking with that trade, at least the individual analysts who cover these stocks. If we look at those price targets, except for Tesla, they're all on average looking for upside here. That said, they're all expecting less upside than we saw last year. Without exception, all of those Magnificent Seven stocks, if you calculate the change from the close on Friday, last Friday, to the price target, we're talking about a smaller gain than they saw in 2023, or in Tesla's case, a loss. So it is optimism, but it's sort of more muted optimism going into this year. One of the folks who's a macro person who looks at this is David Kostner over at Goldman Sachs. He says the baseline is that mega cap tech stocks will continue to outperform the remainder of the S&P 500, although it should be said, the forecast for the S&P overall, there's a big range, but most of them are also for modest gains in the index.
There are some, you know, very dedicated tech bulls, though, who argue people are being too conservative. And I think it comes down to where the AI, and they see these companies, and this is the very bullish case, they see these companies continuing to invest. They're going to keep integrating that tech across their products, across their services, and they just are making a bet that use cases and monetization is going to keep ramping. So
well, a couple of individual things that I just quickly want to mention that's going on today. One of them is that Apple shares are trading lower. They got a rating over from Barclays that is pushing the shares down.
The very rare downgrade to sell.
Yes,
on
exactly.
the iPhone. You don't see that very often.
Time for a breather, they say. So we're going to talk more about this later, but you could argue, given the size of Apple, as Apple goes, the rest of tech and then the rest of the market goes. So that's definitely weighing on things today. On the flip side, you've got Tesla, which is out with deliveries. We're going to talk more about that later as well. And so even though the forecast is for it to decline on the year, it had been higher earlier today.
Because they beat consensus.
Off by 2/3. We'll keep watching that one. Well, as we are winding down the first trading day of the year and looking ahead to what investors should be watching for and watching out for in the new year, let's welcome in Torsten Slok, Chief Economist at Apollo Global Management. We should mention Apollo, the parent company of Yahoo. Torsten, Thanks so much for coming in. It's such a pleasure to see you. What a great way for us to start the show in this new year. I'm going to start, though, on a bit of a more downbeat note, because there is a decent amount of optimism this year. But what do people need to be worried about? What are the risks heading into 2024?
I think there are two key risks this year. First of all, as you just talked about, last year's gains were really concentrated on a handful of stocks. So I think that looking at the market today, we need to think about, if I take a fresh $100 and put to work, what am I actually investing in? Am I buying the AI story, as Josh was saying? Or am I buying in the 493 stocks that were not the AI story? What is the view that I'm expressing if I do decide to buy the S&P 500 today? So I think that the really unusual driven higher in stocks by a very, very small handful of names was so unusual that we need to think about that as where we sit today. So first of all, the concentration in the rally yesterday is very critical for anyone who thinks about markets at the moment. The second thing, which I think is a much broader topic, is this issue: is the Fed really done fighting inflation? The problem was that the Fed pivot has been interpreted by market as all problems are solved. COVID is solved, inflation is solved, nothing to worry about, excuse me, hooray, hooray, everything is fine. But now you look at it today, is that really what they said? Several FOMC members afterwards have come out and said that's not quite what we said. And at the same time, this rally in the market is probably going to result in a boom in housing, in the labor market, in consumer services, in consumer goods, in travel, in airlines, hotels, restaurants. All that combined means that maybe the Fed swung the pendulum too much in the dovish direction. And therefore, if the Fed now needs to pull that back more and say we're not quite done fighting inflation, you have overinterpreted what we did in December, I do think that markets will have a more bumpy road ahead, where equities will begin, in particular, but also credit, will begin to look at, well, maybe the Fed is not quite done when core CPI today is still at 4% and their target is to be 2%. So we're just not there yet, because 4 is not 2, and therefore we're just not yet can declare victory over inflation.
And Torsten, so that's exactly right. So the Fed chief, Jay Powell, last time he spoke, you're right. I mean, markets reacted. It was time to party. We saw the rally in stocks and bonds. What is your expectation, though, then, Torsten, given all these kind of puts and takes next year? When do you think the Fed cuts, and by how much?
Yeah, I think that the Fed will start cutting rates later than what the market is pricing. At the moment, the market is pricing that the Fed will cut 6 times this year. The Fed themselves say we will only cut 3 times. So there's a quite wide divergence between what they are saying and what the market is pricing. But what I think is most important is exactly to your question, Josh, that if inflation is at risk of not coming down so quickly, and if we now are on top of that at risk of the Fed turning their message around, might actually be lifting inflation over the next several quarters, well, then I do think that the Fed's communication is going to be very similar to what they had in 2022, namely, we're not done yet, we're not done yet. And if that's the case, we in markets should also be looking at things from, well, if they're not done yet, that perspective means maybe we should also be still a bit cautious on the upside to equities.
There are also some other risks that have been discussed for a while out in the market. And I think of credit in particular, right? I think of commercial real estate as well, and the risks that people think it might have for bank balance sheets. Those have kind of been floating around out there, and they haven't yet come to roost. Is that something that people should be watching this year?
Yeah, this is also very important. 70% of all commercial real estate loans in the banking sector are on small banks' balance sheets. And banks here in this definition is banks number 1 to 25 are large banks in the Fed data. Bank number 26 to 5,000 are small banks. So bank number 26 to 5,000, they have about 70% of all commercial real estate loans in the banking sector outstanding. So that means that a lot of the risks, in particular to commercial real estate, are on the books of the regional and the smaller banks. And with the office prices in the US down now 40%, that of course means that a lot of those loans to commercial real estate that need to be refinanced. Remember, a commercial real estate loan is a 30-year asset, but it's financed with a 5-year loan. So a 5-year loan that suddenly is refinanced at a much higher level of interest rate. Say, let's say you did a loan in 2018, you wake up in 2023 on next year, 2024, and 2025, and you suddenly have to refinance that loan at a higher interest rate. Not only do you need to then pay up more to refinance it, but you also have to pay the equity because the value of the underlying asset is down 30, 40%. So that's why there's a lot of headwinds still to commercial real estate as at least another risk. And as you also mentioned, other risk when it comes to credit is that we've had a very significant rally in lower rated credit, in loans and in triple Cs, the lower end of quality of high yield. All that also looks a little bit premature when you think about the risk that the cost of capital is going to stay higher. So I would say, summarizing our conversation here, I think that the main risk is that we are underestimating page 1 in the finance textbook, where it says that when the cost of capital goes up, it does have a lot of consequences both for credit and for equities.
I'm interested, Torsten, to another key thing we have to think about here is the consumer, who's proven remarkably resilient. And they have that labor market is sturdy. As you look ahead now, Torsten, what do you see for the consumer? Because some folks say, listen, on the one hand, they see a labor market that's cooling. It's not crashing, but cooling. They talk about dwindling savings. On the other hand, also resumption of student loan payments. Exactly. How do you add all that up? Where are we with the consumer?
Well, I think that there are three factors impacting consumers at the moment. The first one is that consumers had a lot of excess savings after the pandemic. It just happened to be the case that consumers saved a lot of money after the pandemic because of stimulus checks, unemployment benefits, and because also we were not traveling, we're not going to restaurants, we're not staying in hotels, not flying on airplanes. That meant that households by late 2021 had about $2 trillion in excess savings that they would otherwise not have had. And running down those savings have taken quite some time. And that's what we're getting to the tail end of that. There's a lot of Fed papers that are showing we're getting to the end of that consumption boom that we have had as a result of these excess savings. So that tailwind is running out of steam over the next several quarters. Exactly as you're saying. Secondly, student loan payments have restarted on October the 1st. That created some headwind to consumption, in particular in October, but that's also a key risk looking ahead. The third and final issue impacting consumers is that now, if we have mortgage rates coming down because of the Fed pivot, if we have auto loan interest rates coming down because of the Fed pivot, if we generally have interest rates moving lower, that could actually provide a boost to consumption. So we have a little bit of a mixed forces with the tailwind coming from households running out of excess savings and student loans restarting. But at the same time, because of the Fed deciding to turn more dovish and the market interpreting that in a more dovish way, that's now becoming a bit more of a tailwind. So we don't anticipate that this will create a sharp slowdown, but it is very critical that excess savings running out will begin to probably give a path for consumption where we are going to see a slower growth rate over the next several quarters. So that should be a softer landing for the US economy overall.
What's going to happen with wages on the other hand?
Yeah, the labor market, as just mentioned, has been very, very strong. And I know you've covered this very well, of course, on the show for quite some time, that if the labor market is so strong, well, then consumption of all types of retail goods, discretionary, staples, should be also very strong. So far, the labor market has remained incredibly resilient because firms have been very reluctant to fire workers, and therefore labor hoarding. They've been holding on to workers to make sure that they didn't get into a situation where they didn't have enough workers. So therefore, we should expect to see on non-farm payrolls on Friday, we probably get that closer to 180,000. That still should be something that should be consumption supportive, at least for quite some time. So again, very consistent with a general slowdown, not a hard landing, not a no landing, but a soft landing, which again means that the Fed is probably not quite done because inflation is still at risk of having this tailwind from the economy still doing okay.
So to wrap it up, something that we're asking people is sort of New Year's resolutions for investors going into 2024. What would you say to that?
I would say coming out of last year, what you two just discussed, I mean, this issue of, we should all be, of course, happy when we get higher returns in our portfolios. But the composition of these returns really matter. Were I diversified enough in my investments? Did I only have essentially an AI story that created incredible returns last year? I mean, incredible by so many metrics, because if you look at the returns and the concentration, there's just so many things that are just out of whack relative to where this was historically. So I would say, look at your portfolio and think about, am I willing to buy into the AI story again? I know today the market is disagreeing with that, but I do think that thinking hard about, am I diversified enough in my investments? Am I just essentially investing in the AI? Am I enough in credit, in alternatives, in other asset classes that can try to spread out my risk so that, yes, great, let's say I had the S&P for all the last 365 days. It's good, I had some nice returns, but now it's probably the time to begin to think about, do I want to be exposed to the same type of risk given what the rally was and how strong the gains were in a very, very small group of stocks? The S&P 493 were essentially flat last year. That tells you that there's a lot more homework now to be done in thinking about what are the other opportunities. How can I make sure that I'm not only exposed to those 7 stocks that have driven returns so much?
Torsten, a very smart New Year's resolution for our viewers.
Thank you.
Thank you so much for your time and insight. Appreciate it.
Appreciate it.
Diving into some of today's top trending tickers. Shares of Moderna rising today following an upgrade to outperform. It's coming from Oppenheimer. The analyst highlighting the company's COVID-19 vaccine sales. Moderna also getting a boost after the CEO reiterated the company's goal of achieving sales growth in 2025. We're going to speak to the analyst behind the upgrade, Oppenheimer's Hartaj Singh, later in the hour. So this one, if you're bullish on the name, Julie, it actually hasn't been so easy. stock's down about 40% in the past 12 months. But here comes, as we said, Oppenheimer. They moved to outperform, so a buy. Target 142. How come? Kind of different reasons he walks his clients through. But one is, it sounds like they think, listen, COVID-19 vaccine sales, he thinks are going to hit a low this year and then increase starting in 2025. And they're also making an argument based on it. Looks like operating expenses. They expect OPEX to drop significantly next year in 2025.
Now, remember, Moderna has been a single product company.
Right. And
so part of Hartaj's outlook has to do with it becoming a multiple product company, at least sometime in the next few years. They're looking at launches to treat or vaccinations against things like RSV and influenza. And then they're looking for catalysts in some of the other experimental drugs as well. And this coming as there was a new shareholder letter from Moderna CEO Stéphane Bancel, who reiterated effectively that the company is going to have sales growth in 2025. Now, that's not 2024, but it is something for investors to potentially look ahead to. And look, there's the other fact, too, that I mentioned earlier, which is that Moderna was the worst performer in the S&P last year, so you do tend to have this bounce effect. Now, will it be borne out by some of this fundamental optimism? We'll see, and we'll talk to Hartaj about it.
When you see a stock get hammered like this, you can see more folks kind of move into the buy column. What's interesting here is, obviously they begin to think the bad news is priced in. Actually, the street's pretty split still on Moderna. They got 12 buys, 12 holds, 2 sells.
Interesting. Let's talk about crypto now, because the latest Bitcoin rally has crypto-related companies moving again today. Coinbase, MicroStrategy, Marathon, all posting big moves as Bitcoin itself tops $45,000. That's the first time it's done it in a couple of years. Now, what's interesting is these other tickers are trending. Coinbase, MicroStrategy, Marathon Digital, Riot, anything having to do with crypto, but they're not all up along with Bitcoin, which is interesting. A lot of them have seen big gains in recent days and recent months over this optimism that we're going to see an approval for the Bitcoin spot Bitcoin ETF. Interesting commentary out from Bernstein's Gautam Chagani, who said that this is going to be a breakout inflection year for crypto. So there's definitely some optimism being baked into the currency today, even if the impact on the stocks is a little more mixed.
Yeah, and as you point out, some of these names have just ripped higher. I mean, Coinbase is up about 370% in the last 12 months. Look at Marathon Digital. It's up about 580%. So they've moved hard. There are a couple of very interesting, you can think about them as tailwinds. We talk about the spot Bitcoin ETF. That deadline is fast approaching. The SEC has until January 10th, right, to make a decision on the ARC21 shares ETF. And we've talked to a number of folks. There is this confidence that the SEC is going to approve that. And then you also have that so-called Bitcoin halving coming, which is planned for April. So that there you're referring to this process that curbs the supply of new tokens, and that's seen as potentially another catalyst. So you do see these tailwinds, and coming off, as we noted, just huge moves in some of these names.
Yeah, one other thing I noticed today, Coinbase is replacing its head of custody, Aaron Schnark being replaced by Rick Schonberg. Why is this important? Well, Coinbase has been chosen as the custody partner for a number of these spot Bitcoin ETFs if they get approved. BlackRock, Franklin Templeton, Grayscale.
Right.
So basically, this is their partner to custody those assets. So Coinbase is getting ready by making that management change, it seems.
Changes to watch.
Yeah.
All right, finally here, shares of fashion company Tapestry rising today. It's after JP Morgan added the company to its focus list and raised the price target to 46 from 41. So the team at JP Morgan, they're already overweight the name, so they're a buy. What they did was add the stock to their analyst focus list as a, quote, value idea, raise their price target. They expect strong performance from the Coach brand in particular, is what they were mentioning, Julie, over the holidays. Notably, they pointed out in North America, and more broadly, it seems like they're telling clients, listen, we think this company is well positioned in what they call a resilient and durable category. And by that, they mean the premium handbags, the small leather goods, and the footwear.
Now, remember, they're the parent company not just of Coach, but of Kate Spade and Stuart Weitzman as well. So that's the company that they're talking about. I thought it was interesting here. Coach specifically, Matt Boss and the team over there at JP Morgan, saying that they saw an improvement in Coach's net promoter score. It's basically a measure of how people feel about the brand, that they saw an 11% sequential improvement in that Coach brand perception in November. In Google Trends, also seeing improvement here. So interesting that there's sort of this if not an inflection point, certainly a gradual ramp upward in perception of Coach. So we'll see how that pans out this year.
Yeah, and before you all pile in, the analysts, they do point out the risk to their call too, right? They talk about competition, increased promotional activity, failure they talk about, what if they don't turn around brands like Kate Spade, but they're bullish. And in fact, most analysts covering this name are fans. You got 15 buys, 8 holds, just 1 sell at this point.
Interesting. What did Coach do last year? Or what did Tapestry do last year? I'm gonna check real quick. It was down. Down. So, we'll see if it has that rebound this year. All right, we're just getting started here on Yahoo Finance Live. Coming up, a new installment of our series, Goodbye or Goodbye. We're looking at the airline sector with Citi analyst Steve Trent. That's later this hour. Plus, Tesla set a new delivery record for the fourth quarter, but new EV rules could put a dent in sales this year. We're taking a closer look. And the rise of buying online is also changing the way the biggest names in retail deal with returns. We're going to tell you about that. Much more Yahoo Finance after the break. Automakers out with their fourth quarter delivery numbers. Rivian and Tesla shares, well, they were moving in opposite directions on the news, although one is down much more than the other. Pras Subramanian is here with us on set. We're talking about Tesla and Rivian specifically. Tesla is now down a little bit. It had been up. Rivian has been down.
Yeah, I mean, Tesla trading in that little range there with a record-breaking quarter, but many that people had expected, 484,000 deliveries in Q4. Estimates for about 483, so just a smidge above what the Bloomberg consensus was. Production, by the way, 494,000, almost 495, easily topping that 482 consensus estimate there. The Model 3 and Model Y production numbers there are pretty big there. They don't break out regional, but presuming China and Fremont were the big locations there for those two vehicles. And then for the year, Tesla deliveries up 38% year over year, which is sort of what they were aiming for, 1.81 million production units there. But Rivian, you said that's not getting hammered here today. Not bad numbers, 13,900 vehicles, which is about a little less than expected, but over 50,000 for the year, production-wise, which is pretty good. Their target, their delivery target was over 50,000. Production target was 54, and they hit 57. So good numbers there from a production standpoint. The question is, can the good times keep rolling?
I have to say, anecdotally, I've been seeing more Rivians.
Have you? All around? I have two, actually, a bit more. Yeah. All around. Here's one question before we let you go, Praz. Next year, new rules for EV tax credits, limit options for buyers, I guess. What can you tell us about that?
Yeah, so now with these new battery component requirements for the federal tax credits that are sort of mandating where they want to get these components from, only about 13 cars now, plug-in hybrids and EVs qualify for a partial or full tax credit. Among the plug-ins, we're seeing the good old Chrysler Pacifica minivan. That gets the full credit for a plug-in. You see cars like the Lincoln Corsair and the Jeep Wranglers, Jeep Grand Cherokees that are plug-ins, but also on the EV, pure EV side, a few Teslas like the Model 3 Performance, Model Ys, and the Model X long range, and then also the Bolt EV, the F-150 Lightning, and the Rivians that you mentioned. That's it for the
So
EVs.
what's not?
You're losing the Nissan Leaf, Volkswagen ID4, the cheapest version of the Model 3, and also the Ford Mustang Mach-E, which is actually a pretty big seller, one of the top sellers of EVs in the country. So those are some big ones that are going to be gone. Those manufacturers say they're going to retool how they make the batteries and hopefully get those back into the regime of federal tax credits. So we'll see what happens later on the year. But right now, only 13 cars.
Wow. All right, big trend to watch. Thank you, Praz. Appreciate it. Meanwhile, Tesla, as we noted, coming out with new fourth quarter delivery numbers, reporting a total of 1.8 million in 2023. But China's BYD overtaking Tesla in 2023 EV sales as the global autos market heats up going into 2024 here. For more on the 2024 auto outlook, we're talking to Tom Narayan, RBC lead equity autos analyst. Tom, it is good to see you, my friend. So Tesla Q4 deliveries, they were better than expected, Tom. 484,000. That means 1.8 million for the year. Give me your reaction, Tom, to those numbers and why you think, listen, Tesla is still a buy in 2024.
Yeah, I mean, a lot of people were worried about this number not being able to beat consensus expectations, which were 480,000. So the fact that they beat that shows you that there's still a lot of demand for these products. And if you look at 2024, consensus numbers used to be at 2.3 million. They've actually lowered now to 2.1 million. And at 1.8 million they hit in 2023. It makes 2024 more achievable. They just did a 484, like you said. To hit that 2.1 million for next year, they only need to be a 525 clip. And you heard from your colleague earlier, the Model Y still qualifies for the IRA credit. And some of the others, competitors like the Mach-E now doesn't qualify. So you're getting into a situation where, yeah, you're right. The entry-level Model 3 doesn't qualify, but the Model Y does. The setup is actually good now, I think, for deliveries for 2024 because expectations have come down. So I actually think the setup is better than what a lot of folks were fearing.
Tom, there's a lot that has been made of BYD in terms of the number of vehicles now surpassing Tesla. But when we're talking about the U.S. EV competitive landscape, is anybody coming close to Tesla in terms of number of vehicles sold in the next year, 2 years, 5 years? I mean, do they just dominate in your view as far as the eye can see?
Yeah, that's exactly right. I mean, BYD's strength is really in China for China. And there is a threat that they'll go into Europe. So there could be a threat there. But in the US, over 60% of EVs sold are still Teslas. And like I mentioned now with the Model Y still qualifying for the IRA credit, there's still going to be a force to be reckoned with next year. You also have some facelifts happening next year that could help things along. So BYD, I don't really see them making a big push in the US. You still have tariffs here, right, that we have where maybe Europe doesn't have the ability to do it as much. So, yeah, in the U.S., Tesla still reigns supreme.
And Tom, we also saw this trend of the traditional car companies kind of putting off these EV-related investments. Tom, I'm just interested in what you made of that decision. Good decision, bad decision, and how much of that do you think is actually going to prove to be a tailwind for Tesla?
That's a good point. I forgot to mention that. Yeah, the fact that the EV slowdown narrative has happened could actually wind up benefiting Tesla. more than anybody else. They have the most profitable EVs in the US, so they have the ability to cut price, whereas some of their competitors are delaying EVs, notably Ford, for example, GM. So you could have the situations kind of like the Forrest Gump shrimp boat, where everybody else is kind of out to sea, and they can come in and really gain a bunch of market share, while everybody else is kind of delaying their EV push, and they can cut pricing because they're just more profitable than some of their competitors.
All of this said, Tom, Tesla isn't the only stock you like. You like some other companies too. I want to talk about Ferrari in particular because that one kind of stands out to me. What's the bull case on Ferrari for this year?
Yeah, so for this year specifically, I don't think there's like a huge catalyst really. This is more of a, steady as she goes. It's a luxury stock, not an auto stock. It's a growth stock into 2030 really. But I do think this is one where consensus expectations are always conservative. This company always beats and raises. And look, if you want to own a stock that could pull back, I actually think they could give some conservative guidance for 2024 when they report results in February. That could create a great entry point. Everyone that I talk to wants to own this stock, but they feel that it's too expensive. So you could have a nice little entry point if they give a conservative guide for 24, and then I'm sure everyone will pile in and support the stock. But ultimately, it's a luxury stock. There's not many other companies like this. It's a growth stock. I have them growing at 17% EBIT growth per year from now to 2030. I don't know any other auto stock where you could say something like that.
And Tom, another name you like, Mobileye. Your target there is 53. How come? What's the argument for Mobileye?
Really interesting story, Mobileye. They have a bunch of announcements coming. These guys do the level 2 plus for autonomy for cars. This is not like robotaxis yet, but it's for things like what Tesla has with their FSD product. Mobileye is a supplier, and it's already won a bunch of wins recently. Volkswagen, notably. They have Polestar, Volvo, a lot of Chinese OEMs. And you have this ability. Right now, they sell a $50 product for basic ADAS, and they're about to sell this product, which is more like $1,400 per car. And the margins are just going to explode. So it's just a specific special situation with a bunch of announcements coming in the next coming weeks and months that I think could be one of the big stories of 2024, which is level 2 plus autonomy. As car companies try to keep their pricing high, one way they can do it is to add software and make people like us keep paying more and more for them. And I can tell you, having the car drive itself a lot, maybe not 100%, but let's say 80%, is a huge benefit, a huge asset. A lot of people will love these types of products.
And Tom, I want to get you out of here on this. Listen, we talk a lot about EVs, and for good reason, but I also want to get your take, Tom, as we head into 2024 on pickups. I mean, obviously just critical for the big three. It's the profit center. What do sales and inventory look like, Tom, as we head into next year here?
Yeah, I mean, you had a pretty strong 2023, right? Stronger than what folks were expecting. Volumes are expected to be up like 3% this coming year, 2024. Production is flat. But inventory levels, I do think we may have reached a kind of new normal, even though we're below where we were historically. And what does that mean? That's typically not a great sign. People are buying more stuff online, so therefore dealers don't need as much inventory. So that could mean that maybe price mix could come down, but demand is still strong for these vehicles. Pricing is still holding up. More importantly, if you look at affordability, interest rates are supposed to come down. Inflation is slightly coming down finally. Unemployment is low. So everything we've seen so far should suggest that demand is still strong. But, the shoe that everyone's waiting to drop is price mix coming down. That still could happen. But so far, we haven't seen any signs of it. Demand is still there. And this is still the kind of bread and butter of the U.S. kind of auto demand.
Tom, always good to get your take on the auto industry. Really appreciate it. Happy New Year.
You got it. Happy New Year.
Take care. Coming up, a new installment of our series, Goodbye or Goodbye. We'll be joined by an expert to help navigate the best moves in the airline sector. Stick around, you don't want to miss it. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're scanning the skies on which airline is flying high and which is facing turbulence, prompting caution for investors. I'm here with Stephen Trent, Citi Managing Director and Equity Analyst. So let's get to your goodbye first, and it is Delta Airlines. That's the stock that you like. So let's go through your investment case here, and it starts with the loyalty program, which are very valuable for many of the airlines, but you think particularly so for Delta. And we actually have a look at that co-branded and loyalty program revenue. Talk us through this.
Yeah, absolutely, and thank you for having me. I think that the loyalty program, when you look at Delta, they have a big, large membership of frequent flyers, and for a bank, they are a very attractive counterparty. So those frequent flyers happen to be relatively affluent versus other airlines, and the banks, I think, also see this as an opportunity to take that huge group of customers and cross-sell different kinds of products that they can also offer. So for Delta Airlines, the economics on them buying and selling miles from their partners, the loyalty program partners and co-branded card partners, is big. And there's a large counter-cyclical element to that because you see Delta's revenues from this segment growing, even though broad commercial credit cards are not growing as quickly. So this does give the carrier working capital tailwind. It gives them support in terms of having a less volatile earnings stream. So we think this is a very attractive piece of the investment case that's somewhat overlooked.
Yeah, and this is you can see it's also larger, the money that they're bringing in from that. Secondly, when we talk about airlines, we tend to talk about their brand. How are they viewed by customers? And you say Delta's got a strong one.
I think they have the best one. You know, we could even go back to simple things when we were going through the pandemic here in the United States. Delta was the very last airline to unblock middle seats, when you had a lot of people that were just starting to get comfortable with flying and just beginning to get comfortable with being seated next to a stranger, even though everybody had a mask on. So I do think that was an important differentiating factor. You know, you also look at other aspects of the case. Delta's the only major U.S. airline that did not dilute its equity holders during the pandemic. So no convertible debt offerings, no equity offerings, and with the exception of a very small number of warrants that they issued to the U.S. Treasury Department as part of the CARES Act, they really went the extra mile to protect the equity holder, which I also think is somewhat overlooked by the street.
Right, so strong brand then, maybe on the part of investors too, and not just customers. And then there's also what's happening with passenger trends and passenger revenue trends, both in the U.S. and internationally. What's happening there?
Absolutely. So if one looks at the United States, we've definitely seen a metamorphosis in terms of the way people travel, how consumers decide to travel, and how consumers purchase tickets. Many people are no longer working 5 days a week in the office. So this hybrid work environment has also driven a metamorphosis, so to speak, in terms of how people travel for business. So we've actually seen for this segment really good demand for, let's say, premium cabin or premium economy type service offerings, away from kind of main cabin, no-frill service offerings that you see with low-cost carriers. So that has been a really kind of robust piece of the investment case for Delta. International side is also very important. So transatlantic flow has been very strong. Trans-Pacific flow relative to 2019 is really just starting to spool up. And probably as we look into the coming quarters, Trans-Pacific is going to be a really important growth area where the likes of Delta, United, Air Canada are going to see that benefit. So Delta actually fits nicely in terms of being able to benefit from that.
All right, there is one risk that we have to talk about that you highlighted for Delta, and that's regulatory risk. The CEOs, in fact, of Delta and some of the other air carriers have warned against some changes that might affect their loyalty card programs. How big of a risk is that?
Yeah, look, certainly in terms of what happens on the regulatory side, what happens with government actions, one is to some extent reading the tea leaves. You know, could we have like a big risk that's suddenly going to unravel a bunch of this co-branded card flow that Delta gets from American Express? I don't think that seems like a highly probable case, but could we see some disruption in that? And maybe a little bit of an ebb in terms of the amount of growth they're getting from that segment. I presume that is a broader risk for the entire industry.
Got it. All right, let's quickly get to your stock to avoid here today, and that is JetBlue Airways that we're talking about, one that you're not recommending that investors necessarily hold right now. So let's get to your case on that, and let's move through at some pace here. So first of all, the big news is the merger with Spirit Airlines. And you say that's not necessarily a good fit for investors.
Absolutely. So I think on one level, maybe JetBlue is looking at its own fleet, 12 to 13 years of age. Spirit Airlines does have a younger fleet. Today we have, with JetBlue and Spirit, we've got an issue with geared turbofan engine that could lead to more grounded aircraft for both carriers. But beyond that problem, Spirit Airlines financials look a little bit difficult. So in late 2022, when the deal was announced, Spirit had $3.8 some odd billion in net debt. Latest reported they're up to $5.6 billion in net debt. Late 2022, they were trading around 10 times 2024 EV to EBITDA. They're now trading at over 900 times. So this is a tough thing to absorb. And it's a little hard to understand how the economics of this merger are going to work, presuming, of course, that the courts allow the merger to occur.
Right, that it even goes through. And I pulled the trigger a little early on point number 2, but you're talking about the financials of Spirit, but that's even at a time when JetBlue has not really reattained its EBITDA position and earnings position of pre-pandemic.
Yeah, absolutely. And I think part of that is stemming from what I mentioned earlier, that you've seen this shift to hybrid travel, this shift to economy plus or premium economy away from main cabin. So no frills offerings have done worse in the current environment than they used to. And on top of that, you look at discount airlines, very hard for them to get the block hour utilization that they used to get. But with pilot delays, delays in getting aircraft, shortage of pilots, shortage of air traffic controllers. In JetBlue's case, you have some of those same problems that you have with Spirit. Yes, they do have Mint, which does give them some premium flow. Yes, they do some transatlantic. But if you look at the chart, JetBlue also probably has taken a leg down because of the cancellation of the Northeast Alliance. So that looks like it's hit unit revenue. Right. At the same time that they're also facing the risk of more grounded aircraft with the geared turbofan problems.
Yes, and you mentioned the geared turbofan. How many planes is this affecting, just briefly, and what's the overall impact going to be?
Right, so you have a problem with a powder metal alloy that had some contamination. So each affected engine on each affected plane, that's basically 300 days of ground time just to do the maintenance. Not 100% clear exactly what portions of JetBlue's and Spirit's fleet hit those serial numbers that are affected by this alloy contamination. But broadly speaking, they do look like they're going to be the most affected in the region. So that could mean dozens of grounded aircraft over the next 2 years.
Well, and just like we looked at the risk to your upside case for Delta, the risk to your downside case for JetBlue is basically just that people would go back towards value, right?
Yes, so in JetBlue's case, I think it's actually somewhat related to customers and consumers from lower socioeconomic spectrums that have probably been having a much harder time with high interest rates and high inflation than wealthier consumers. So do we get a rebound in terms of that segment traveling, replenishing this flow into basic economy or no frills seats like you have with a Spirit, for example? Right. I think that's definitely one thing that presents some risk to our very cautious view on JetBlue.
Gotcha. All right, Steve, thank you so much. Really fun. So just to recap what you're telling investors, buy Delta Airlines based on great economics on its co-branded card program, strong brand overall, and passenger revenue trends. On the other side, you say maybe avoid JetBlue right now. Its pending merger with Spirit Airlines presents some risks. It's also facing headwinds from geared turbofan engine issues. Steve and Trent, thank you so much for being here. Appreciate it. And thank you so much for watching Goodbye or Goodbye.
Moderna may have seen shares slide nearly 45% in 2023, but it is kicking off the new year in positive territory. The stock surging today after Oppenheimer upgrades the stock to outperform. The move comes in part due to the biotech company's COVID-19 vaccine sales expected to rise in 2025. Joining us now is Oppenheimer analyst Hartaj Singh. Hartaj, it is good to see you. So you're a believer now, Hartaj. Moderna, you go to outperform. Your target is 142. How come, Hartaj? Explain to us why you think Moderna is now a buy at these levels.
Great. Thank you, Josh. And Julie, thanks for having me, and Happy New Year to everyone. The best in 2024. Look, when we downgraded the stock in 2021, we actually pointed to a few things that we thought were worrisome. We've been checking those boxes, especially over the last 6 to 9 months, starting with COVID-19 vaccine revenues. There were about 100 million shots given in the U.S. last year. This year looks more like 50 million. We expect that trend to sort of be the bottom going into 2024 and moving forward. If you believe that COVID-19 vaccines sales have sort of, hit a bottom going forward, that essentially funds their pipeline. And that pipeline is very important to us. There's some material catalysts that are coming. In 2024, more catalysts than the company's had in a while. Catalysts with our RSV vaccine, phase 3 in flu, a next generation kind of flu vaccine using the mRNA technology, cancer vaccine, et cetera. And then lastly, operating expenditures. Their CFO, who's been in the seat for about 1.5 years, has clearly outlined how OPEX now going forward will be tied to sales. So, we expect OPEX to go down in 2024 and 2025 and then start slowly growing as sales start growing in 2025. So, you check these 3 boxes and the company sets up really well, which is why we upgraded.
Hartaj, it's Julie here. It's good to see you. Thanks for being here. I want to dig a little bit more into this idea that vaccine uptake might have seen a bottom. Now, does that imply not just that it's not going to get worse? Does it also imply that we're actually going to see an increase? And if so, what would catalyze that? What would drive that?
Yeah. So, Julie, we were in the thick of COVID-19 pandemic, as a team that covered Moderna in 2020, but not just Moderna, Regeneron also, and Gilead, which had products, to help us deal with the pandemic. It was pretty clear to us by 2021 how politicized the issue had gotten, and that created a lot of fatigue. There were competing stories, back and forth, that made people, polarize people a lot. So it got away from being a health issue and into a social political issue. So you combine that, vaccine fatigue with a lot of people, especially on the margins, which is the vast majority of people, also with flu, who get their vaccine shots. And then secondly, we transitioned into a commercial market this year, meaning that the government wasn't just taking orders in the United States. You had to go to, 300-400 commercial payers, 50 plus state organizations, and sell to them. And both these things actually led, we believe, to the market sort of hitting this low this year. I think that with more education, more awareness, more spending, marketing spend, we should start seeing an uptick. It happened with flu. It happens with flu all the time. As the season goes on, more people get the shot. We expect the same thing to happen with COVID-19, going forward.
And Hartaj, you also mentioned the company's pipeline. What in that pipeline, Hartaj, should investors, do you think, be, especially optimistic and excited about? Is it RSV? Is it flu, CMV?
It's interesting, Josh. I would say it's all of the above, and I'll tell you why. One of the things we as analysts look for when we talk about a platform company, quote unquote, like a Moderna, not every biotech is a platform company. In fact, they're very few and far between, is can the platform help the company get better clinical and regulatory success rates? If you go to Moderna's R&D presentation from a couple of months ago, they actually have very interesting slides where they show that their clinical and regulatory success rates are actually higher than historical norms by a decent bit. So this is a company that's using the speed and the scalability of their platform and great science and great clinical trials to bring products to market. So we think, all those 3 products you've mentioned are great. I think the one in oncology is especially important because what we're going to see is not just a company that can use its mRNA technology in infectious diseases like COVID-19, like RSV, like flu, but now can go into cancer, completely different area, and have a really, really significant effect on patients' lives. And especially if it gets approved earlier, we'll know this year if they can file for an early approval.
Hartaj, finally, I want to ask you about something that doesn't have to do with drug development, but rather selling the drugs. And that's that the company doesn't have a chief commercial officer right now. The person stepped down. Stefan Bancel is effectively doing that job in addition to being CEO. Is that a good thing? Is that something that's going to help Moderna? How should investors be thinking about that?
Yeah, we dug around that a little bit before the holidays, with the company. I've known the company since the IPO, and we spent some time talking to them. Moderna is a very high performance culture. It really is. It's, company, again, like I said, I've known through the IPO. It is a company where, it's, the pedal is to the metal, which is why they got, COVID-19 vaccine, approved in 1 year. Took a much larger organization like a Pfizer to do the same thing. So there's a very high performance culture where, if you're not performing, usually, there's change. So I think that's happening right now in the commercial team. I think the reason why Stefan has probably taken it over is because he understands how important, this year and next year is. And he actually came from a commercial background himself, commercial and marketing. So while they're going through a chief commercial officer, while they're looking for a chief commercial officer, probably take them a few months to find the right person. I think Stefan will be very much hands-on to make sure that there's no hiccups, on the commercial side.
Interesting stuff. Thanks as always for your perspective. Appreciate it, Hartaj, and Happy New Year to you.
Great. Thank you for having me.
Thanks. Coming up, we've got the closing bell on Wall Street. First trading day in the books. We're going to check in on the latest market moves and the top trending tickers as the Dow turns green. We have the closing bell. SoFi ringing it today on this first trading day of 2024, January 2nd, 2024, in the books here as we kick things off for this year. And the Dow peeking into the green just as the session was ending, the last 10 minutes or so, finishing the day up by about 26 points, not even 0.1%, but still a gain. And the S&P and the Nasdaq really pairing the declines that they had been experiencing. The S&P finishing the day down a little more than 0.5%. The Nasdaq way off the lows of the day, down by 1.6% when all was said and done. Interesting, because as I said, things were pretty dire earlier in the day. The index fell as much as 2.2%. So definitely pairing that. Still, it was the worst day for the Nasdaq Composite since October 26th. And then looking at some internals that were driving that, we talked about Apple earlier. Yep. We're going to talk about it a little bit more. It's having its second worst session going back to the first trading day of 2023. And then the semiconductors having a pretty lousy day. Their worst session going back to October 25th. So the semiconductors down big as well. Now, we keep talking about this sort of reflexive rotation that tends to happen early in the year. And so the semiconductors, huge outperformers last year. So when you see the selling to begin the year, it makes sense that people are still kind of lightening up. But nonetheless, it's interesting to see that size of a move here.
Yeah, for sure. And you mentioned Apple, so let's stick with that one, because that was certainly a weight on the stock market today. Sliding after Barclays downgrades that stock to underweight, lowers its price target by $1. Barclays citing weakness in iPhone volumes and mix, while other hardware categories expected to remain weak. So this is a big one, Julie, because you don't often see analysts downgrade Apple to the equivalent of a sell, but Barclays did. They go to underweight. Time for a breather, they say. The target 160. Bottom line, they say iPhone 15 sales are lackluster, their words, according to their own checks. The next iPhone, the 16, which you would expect in September, they think will be more of the same. And as for Macs, iPads, wearables, they see a lack of a bounce back there.
Interesting, they pinpoint China in particular as one of the areas of weakness here. Biggest takeaway from the latest check, says the note, is incrementally worst iPhone 15 data points out of China, together with developed markets remaining soft, which was quite interesting. Here's a little bit of anecdata. Love the anecdata. I just got a new phone, full disclosure, a new iPhone. I got the iPhone 15. I went in planning to get the 14, got it from a Verizon store. I'm very transparent here.
Yeah.
And they said, if you turn in, first of all, they had no stock of the 14, which tells me that there's more demand for the 14 right now than for the 15. Secondly, they gave me a deal on the 15. There was no such deal on the 14. So it seems like there are some incentives here to try to push out more 15s. That was my very anecdotal reading between the lines.
Yeah, Barclays could have surveyed Julie Hyman and just written the note off that. It's interesting because when you think about Apple, listen, it had a very strong 2023. The key question for investors is now, how do they get this top line going after 4 quarters in a row of declining sales? And when it comes to the U.S. and China in particular, what is iPhone demand going to look like in the quarters ahead?
Yeah, I have to mention, sort of circling back to the discussion we had at the top of the show, the average price target for Apple, according to Bloomberg data, $199.50 for the end of this year, which implies only about 3.5% upside. That's after the 48% gain that the stock saw last year. So all of those Magnificent Seven are expected to have more muted gains. But I think besides Tesla, that's the lowest number that we're expecting, at least analysts are expecting. That doesn't mean they're right, but it just tells you something about the expectations game. Let's talk about Chevron as well. Watching that stock, it's warning it's facing billions in charges for the fourth quarter. The company citing regulatory challenges and environmental liabilities. Now, this has in particular to do with what's going on in California. The company says it's going to write down the value of $3.5 to $4 billion worth of assets. And it's kind of a political story here. The shares are not affected that much, but basically it says that California is over-regulating the company. It says California regulations have resulted in lower anticipated future investment levels. By the way, Chevron is headquartered in California here, and the company said production in California has dropped 15% since the pandemic and now is only 3% of its output globally here. So basically, California regulatorily does not have a very friendly stance towards fossil fuels. And so that's kind of what's at the heart of this issue.
Yeah, and Bloomberg has a good write-up too, just looking at kind of the relationship between Chevron and the state of California, my home state, noting it has been, I think we can call it, let's call it rocky.
Yeah.
The state sued Chevron, said the company, others kind of lied about climate change. Then Chevron shot back, disputed that, of course, but did cut back on refinery investments, talked about a difficult business environment there. It hasn't been easy going for Chevron if you've been long that name. Stock's down more than 10% in the past 12 months. The most financial analysts, they do cover Chevron. They argue it's a buy here.
One more interesting thing here, it's not just California, by the way. There are old installations in the Gulf of Mexico that are now
Correct.
going offline.
Yep.
Even if Chevron doesn't own them anymore because of U.S. law, not California law, because of U.S. regulations, it still has to participate in the cost of cleanup for those now closed installations, which is interesting.
It is interesting, though, because as you mentioned to begin with, the stock actually finished higher today. And I don't know if that's just because...
Maybe not a surprise?
Maybe not a surprise, or it's good news, let's get it behind us. Or maybe they thought the number was going to be bigger. It was an interesting reaction. Finally, shares of Citigroup getting a lift as Wells Fargo analyst Mike Mayo predicts Citi stock will more than double over the next 3 years. This comes as Wells Fargo named Citigroup its top pick for big banks in 2024. So when Mike Mayo speaks, Julie Hyman, we know Mike, investors pay attention. Name Citi as top pick among the big banks, at least for this year. Think shares can double over the next 3 years. His base case, it looks like the stock rises to about 119 through 2026. So many investors don't want to hear about Citigroup, Mike was saying, but to Mike, that's actually this kind of bullish indicator. He likes that kind of negative sentiment, says, okay, I like that. It means probably a more favorable setup.
Mike Mayo, both a well-known bank analyst and a well-known contrarian, right?
Yes.
So it's not surprising that he says the sentiment here is very bad, so I want to get in. JP Morgan had long been his favorite stock. He's talked up JP Morgan for a long time. Now Citi is his top pick for this year. As you mentioned, it replaces JP Morgan, which I thought was interesting. All of this has to do with what Jane Fraser has been doing at Citigroup, which is a very involved restructuring that we have been talking about for months now, where it's involved moving around departments, cutting jobs as well. He says it's going to be simpler and more profitable as a result of the work that she is doing.
Yeah, equity analysts still actually kind of divided on this one. 11, like Mike, say it's a buy here, but 17 are on the sidelines. As you noted, though, Mike probably likes that.
Yes,
exactly what he wants to hear. Moving on, tech sector seeing huge gains in 2023 with the help of a boom of interest in AI, but the Magnificent Seven might be restructuring in 2024 with Apple's growth woes and looming court cases for Google and Meta. For more on what investors should look for in tech and AI going into 2024, we turn now to Dave Smith, Baylor Executive Vice President, Domestic Equities. Good to see you. Let me ask you this, and we've been asking different strategies and analysts this question, and you're the one to have some unique insight here. So 2023, Magnificent Seven, it was the place to be. I think if you moved in those names 12 months ago, you're feeling pretty good and pretty smart. Do you think you stick with your winners? Do you stick with the Magnificent Seven in 2024?
Yeah, great question, and thank you for having me. It's good to see you again. So, with the backdrop that, today was an interesting day on the market, I think that while tech indices have done quite well, returns have been very concentrated and concentrated particularly in those AI winners and mega cap stocks. And our thesis is that going into 2024 and 2025, we're really going to start to see a broadening of that rally. We started to see a little bit of that in Q4 and in December, and I think that continues in 24 and 25. And the rationale behind that, the thesis is that outside of AI and those large cap winners, you've really seen the economy and tech in particular kind of go through a series of rolling recessions over the last 18 months. You can see it in the tech layoff data. You can see it in the companies that have been really impacted by optimization or budget tightening. And our thesis is that now we're starting to emerge from that and come out on the other side. Budget growth, IT budget growth looks fairly solid. We're hearing that there's a little bit of a kind of return to normal in spending. So our focus is really on broadening the opportunity set, looking at areas that may be underappreciated, cyclical hardware, opportunities in areas of software that have been disproportionately impacted by that year of efficiency. So consumption and seat-based license models, for example. And, we're always watching for risks, of course, but pretty optimistic right now on those areas and that broadening of that rally.
So how do you find, Dave, the right stocks in that broadening? Do you just buy tech generally, right? Or are you looking for specific criteria here within technology that's going to benefit from AI?
Yeah, so it's a really great question. And, there are, on AI in general, what we've seen so far, first of all, we really believe that this is a game-changing technology. We think it's, the pace of innovation here is just so remarkable. And what we've seen so far is really a lot of, on the consumer side, we've seen a lot of potential and a lot of really interesting things that are going on. And then on the enterprise side, you've seen a lot of kind of early stage efforts here. Returns thus far have been really concentrated in the infrastructure layer and the core tech layer. As we start to look out in 2024, we believe that it's going to be the year that the application layer starts to emerge. And in particular, you're going to start to see that in the second half of 2024. So I think what you're going to want to be looking for within that area is what companies are really being innovative here, starting to get uptick with their products that are seeing product market fit, seeing early signs of traction. So you're going to want to be looking for really early signs there, because we firmly believe that there are billion-dollar ideas and billion-dollar companies that are sitting on whiteboards right now. So really amazing time to be an investor. And I think 2024 is going to be really interesting as we start to see some of these enterprise applications start to emerge.
And Dave, when you talk about AI, listen, you clearly, you're excited about the technology, game-changing, as you said, and a lot of investors agree with you. I'm just wondering, Dave, what you made of that headline that dropped, the New York Times suing OpenAI and Microsoft for infringing copyrighted works. Is that a risk, Dave, that maybe investors in AI-focused companies need to think about?
Yeah, and it's a challenging one because I'm not a lawyer and I don't pretend to understand all the really subtle nuances and all these cases. I think it's important to remember that this is a rapidly emerging technology, and there's still a great deal to be discovered in terms of regulation, copyright infringement, as well as how our habits and daily interactions will change and evolve with areas like information discovery and search. But at the same time, I and yourself, we produce content as well. And so I understand that perspective. I think net, I think we should take a step back and think about this as, this tech offers really a step change in productivity and value creation. And so the pie is getting larger, if you will. It's important, we need to be sure that the ones that create value are that pie gets distributed. But I think we're all in the learning process here, and we're figuring out what this new model of economics is going to look like.
And Dave, there's a fun question we've been asking folks, which is sort of what's a New Year's resolution that investors should make for 2024?
Oh, that's a great question. New Year's resolution for investors, fascinating. So, I think it is important. It's been really easy in the past couple of years to kind of stick with the large cap names that have done really well, and names that are really easy to like. I think it's going to be increasingly important to kind of seek out those undiscovered names and really do the hard work on names that have been disproportionately impacted over the last year. So that could be both, cyclical hardware companies that we discussed, but also growth software companies that may have been, really impacted by that year of efficiency and have kind of had a wet blanket on growth for the past year or so. So I think New Year's resolution is going to be, do the work on those undiscovered companies and come up with some really unique ideas.
All right, Dave Smith, good one. Ballard, Executive Vice President of Domestic Equities. Thank you.
Happy New Year. Thank you.
Happy New Year. It is the start of a new year and historically the biggest month for fund inflows. With more on why, Yahoo Finance's own Jared Blickery. Hey, Jared.
Hey, Julie, lots of talk about the so-called January effect, which can mean a couple different things. But in general, I think most traders take that to mean January, in fact, sees the biggest inflows. And this chart demonstrates exactly that. This is the median monthly mutual fund and ETF flows as a percent of assets under management. And the greatest amount, which is just over 20 basis points, is in January. However, it's important to state this is not a seasonality play with respect to price, where you sell in May and go away, or the Santa Claus effect or the Santa Claus rally, where you're long the last 5 days of the year and the first 2 trading days of the following year. I think it's important, though, because guess what? There's a ton of cash on the sidelines, a lot of retail investors getting over 5% in their money market funds, and this could come flowing back theoretically. But I mentioned seasonality, and I want to show you the pure seasonality play, because this is the S&P 500, its average return since 1949, broken down by month, and I have 3 different ways of looking at it, whether it's the presidential cycle, we happen to be in year 4 right now, whether it's a Democrat president in year 4, or just all years. But what's clear is that January is not really a standout month. And in fact, February, it looks like, is a little bit negative on average. By far, in a presidential election year, the best month to be in is right after the election in November, but that's not coming for some time. Just getting back to the original premise, what can we expect in January? As far as predictions go, I just mentioned the Santa Claus rally, which is actually an indicator. These 7 days can predict whether the entire year will be positive or negative, and you combine it with some other January indicators, it can be pretty powerful. But over the last 6 days, and that we have one more day to go, it is actually negative right now. So this is forecasting, if it ends negative tomorrow after the 7th day, potential red at the end of the year. Already we're talking about this.
Jared Blickery, thank you for that. Appreciate it. Still to come on Yahoo Finance Live, Carrier Global announced that he has completed an acquisition of Viessmann Climate Solutions. We'll talk to the CEO to break down what the deal means for Carrier. Stick around.
Carrier Global closing its acquisition of Viessmann Climate Solutions today after the deal was approved recently by the European Union. And the company has been busy in the deal space, selling a commercial refrigeration business to Honeywell for nearly $5 billion last month, and it's putting other businesses up for sale this year. Joining us now is David Gitlin, Carrier Global Chairman and CEO. Thank you so much for being here.
Thank you, Julie. Thank you, Josh.
And you have been making these changes, but really it's about an overall remaking of Carrier, right? So talk to us about the vision of how investors, how the public should think about what the new Carrier is.
It started with our North Star, which is to be the global leader in intelligent climate and energy solutions. Effectively, all things come back to sustainability for us. So we actually are in the process of divesting one of our 3 divisions, our fire and security business, because we said that did not ladder up to our North Star. Our stationary refrigeration business, we just announced a sale for that. And the really exciting thing that we closed on this morning was buying a company that's all about sustainability. It's this Viessmann Climate Solutions business that not only does heat pumps, which is electric, it's a transition away from gas boilers to heat pumps, but they also do solar PV, they do battery storage, they do complete home energy management solutions with the heat pump, with the utility overlay. So it's really, for us, all about sustainability. And when you think about business, the ability to be part of a transformation of a company is one of the most exciting things. So we are so energized about 2024, and we're starting on a great foot with our closure of Viessmann Climate Solutions today.
And Dave, for Viessmann, I'm just interested, so it's not the only player in Europe. What's the competitive landscape look like over there? And what are sort of Viessmann's advantages?
Well, it's very difficult to break into the residential HVAC space in Europe. We're usually number 1 or 2 in just about every space, number 1 in commercial for HVAC in Europe. But when you look at the residential space, it's many multi-generational family-owned businesses. And we happen to hit it off because we are so complementary. What really differentiates them is, number 1, their channel. They have a direct-to-installer relationship with 80,000 individual installers. Number 2 is their brand. It's respected obviously throughout Germany, but throughout Europe as well. They have a technology advantage, and they're the only company in the world that has complete home energy management solutions.
So you talked a little bit about heat pumps and sort of this transitional energy phase that we're in. 5 years out, 10 years out, 20 years out, how are we going to be heating and cooling our homes and office buildings?
Electric. Yeah, so when you look at you think about transitions you're seeing to varying degrees in automotive as we transition to electric vehicles. You want to bet on the right company in the right space. If you're in the United States, you'd bet on California. 5 years ago, 2% of the vehicles sold in California were EVs. Today, it's 20%. If you look at just 2 years ago in Germany, they were selling 100,000 heat pumps a year. Today, this past year was 300,000. A couple years from now, it'll be 500,000. The growth in this transition from gas and oil boilers or furnaces to heat pumps is exponential. And that's why it's happening most in Europe. So that is the space you want to be in. Just like the California for EVs, that's Europe. And it's a combination of consumer interest moving towards more sustainable solution, but it's also subsidies. There's 21 countries in Europe that have subsidies encouraging this transition to heat pumps, but it's also regulation. There's 12 countries in Europe, that have now banned gas and oil boilers for new home construction, and they will outlaw it for replacement in the next 3 to 5 years. So the growth there is going to be exponential.
And is the way you guys operate that you're agnostic of the source of the electricity, so to speak? In other words, solar, I guess geothermal's in there too when you're talking about some of these heat pumps are enabled. Like, how does that all fit together?
Well, yes, to some extent, but we also have a commercial heat pump business as well. So we can be part of the solution. So as you start to see a transition to district heating as well, it's really a nice solution for us because we can provide the commercial heat pump for the underlying energy. Then we can also provide like apartment transfer units once it gets to the apartment. So we support all things renewables. And what's nice about Europe, especially, is that everyone has to ladder up to Fit for 55, which is 55% reduction in CO2 emissions by 2030. So it all comes back to all things sustainability.
And Dave, you talk about this big transformation that's occurring, but I'm interested in how sort of the macro plays into this, concerns about the economy in 2024. How can a weak economy affect demand in residential and commercial?
What's nice about Carrier is we have balance. We saw it last year. Like last year, we saw a weak housing market in the United States. We saw some challenges in Europe, but we still had nice growth. We're going to grow into 2024 as well, for sure. Not for sure, but we feel very confident in our growth in 24. It's because when you fish, you go where the fish are. With customers, you go where the customers are. So if you see a little bit of tightening in housing, we can pivot to data centers. If we see infrastructure slow in certain areas, we can move over to commercial. So I do see, commercial construction has been a little bit weak. Maybe it starts to come back a little bit in 24. The housing market should rebound a bit in the United States. We do see very strong growth in residential in Europe because of these transitions I'm talking about, this transition to heat pump. We're very bullish on India. We're very bullish on Saudi Arabia. So what we at Carrier have done very, very adept at is controlling the controllables. The economy will, do what it's going to do. we actually always see pockets of growth depending on the right vertical in the right countries.
So let me ask that a different way then. What are you seeing in your business? Let's talk specifically about the US for a moment. And what does it tell you about where we're going to see growth this year? You know, how is residential going to be, for example, versus some of those other areas you talked about?
Yeah, when we looked at the United States, what we would have seen last year, for example, was weak on the housing side for the replacement business because we had been coming off 3 years where it was so strong, so many people moving. Mortgage rates, 8%, that had a bit of a dulling effect on the housing market. Now they're 30 years down to 6.5. We should start to see that rebound a little bit. There's pent up demand for people moving. Commercial construction was light last year. I think that probably continues a little bit. We saw very good strength in K through 12. A lot of money going into that. A lot of money going to higher education. A lot of money going into healthcare. A lot of money going into data centers. The CHIPS Act's bringing in back infrastructure spending into the United States. So we saw in some of the key commercial verticals very strong growth. Our backlog in our commercial HVAC business is up 40% on a 2-year stack.
So that's still going to continue.
Yeah, that continues into next year. That means we're pretty well booked for the year in commercial HVAC as we go into next year. So we see strength there, and then we start to see on some of our shorter cycle businesses, our backlogs are kind of back where they normally should be. So with economies start to rebound a bit, that short cycle business should get some lift as we go into next year.
All right, we'll be watching. Dave, thank you so much for your time and insight and coming in today.
Thank you, Josh. Appreciate it.
And coming up, the rise of online purchases is changing the way retailers deal with returns. We speak with the CEO of Loop Returns on the other side. Stick around. Retailers are rethinking the way they manage returns in the wake of a record holiday shopping season. On December 26th, historically the biggest day for returns, Total volume was up more than 35% from the year prior. It's according to data from Loop Returns. And joining us with more on the evolving returns landscape is Jonathan Poma, Loop Returns CEO. Jonathan, it's good to see you. So that's a number that stands out there, Jonathan. December 26, total volume was up more than 35%. Do we have any line of sight, Jonathan, into what is being returned? Not so much specific brands, but broadly, is it clothing, furniture?
Yeah. Pleasure to be here today. Thanks so much for having me. I think across the board, maybe it's a cliche, but I think anything being online is returned. We see in industries like apparel, the return rates are as high as 20 or 30%. But even in home goods, in health and beauty, you're seeing 5, sometimes double-digit 10% return rates. So it really just comes down to, e-commerce is continuing to grow. Return rates in e-commerce are significantly higher than return rates in retail. And then specifically in holiday season, when we're buying gifts for other people, those return rates go up even further.
And Jonathan, I'm really curious how returns have changed, even during the era of e-commerce, if you will. For example, it used to be you got something, you could send it back, no problem, no cost. That seems to be changing as well. What are the biggest changes we have seen in the last year or two?
Yeah, totally. And you're right. Things are changing. I think, primarily maybe 2 things are happening at the same time. Consumer expectations continue to rise. So shoppers want free, they want easy returns, and logistics costs continue to rise. E-commerce logistics, the market is going to grow 6% annually over the next decade, ultimately becoming a $3.2 trillion market. And transportation and labor costs are really driving those costs higher. So merchants, their P&Ls are under scrutiny. Logistics is an area of focus. And with those increased costs, we're seeing merchants really try to dial in their policies. Retailers like Amazon, for example, they can leverage a massive data set to decide what customer should and shouldn't get a free return, what customer is abusing a policy or is executing a fraudulent return. And these direct-to-consumer retailers with a smaller data set really can't do the same things on their own. So they're introducing fees, introducing returnless refunds, and introducing all sorts of new things to try and reduce return volume overall as a percentage of sales, reduce returns and reverse logistics costs, and really mitigate the impact of returns, fraud, and abuse.
And Jonathan, I had this experience where I had a piece of furniture, Jonathan. I wanted to return it. And the company said, you know what, Josh, no worries, no drama, full return, but keep the furniture. We don't want it back. How much of a trend is that?
Yeah, it's a significant trend, Josh. We call that returnless refunds. And we've seen that up in our merchant base 55% year over year. And then obviously what we're trying to do on the back of it is help merchants continue to offer that when it's right and to mitigate the ability of bad actor shoppers from figuring that out and buying a $1,000 sofa and realizing that merchant's going to let them keep the item and give them a full refund.
Well, on the flip side, though, what's sort of the brand risk with that? Like, Josh is now stuck with something he doesn't want in his house, and if he wants to get rid of it, it's a pain in the butt to get rid of
firewood.
A piece of furniture. No, I mean, seriously though. So, it seems like that's a little bit of a double-edged sword.
Yeah, and Julie, to make sure I understand clearly what you're talking about, you're talking about if maybe a mattress, you buy a mattress, you don't want it, and all of a sudden the merchant's like, yeah, no, we'll give you a refund, but you got to figure out how to part ways with this. Yeah. No, it's a great question. It certainly is something happening in categories like home goods that might not happen elsewhere. Usually what we'll see is honestly that the shopper's willing to take the refund, and sometimes it's a pleasure and they can keep the item or give it to a friend or family. But other times I've actually been party to this myself, having to dispose of a cooling mattress cover. It's like, yeah, please. I was told, please dispose of this in like the most sustainable way possible. And it's like, yeah, I'm going to drag it out to my curb. So there's certainly a challenge there that certainly we have an opportunity to try to solve.
And Jonathan, I want to get you out of here on this. This relationship, Jonathan, you now have with a firm. Talk to me about how that partnership came about and kind of just what it's meant for your business.
Yeah, it's really been a pleasure. It came about, I got to know Max through 2021 and 2022, being sort of partners in the Shopify ecosystem. Max Levchin at Affirm, and I think we really found common ground with each other, caring a lot about our merchants and their shoppers, and enabling our merchants to deliver best in class experiences. Time flies. That deal feels like. In some ways, it was just yesterday, and in others, it was an eternity ago. But we're only, 100 days or so into the partnership, and priority one was together making sure that we took care of our merchants, enable them to get over to Loop, have a stable holiday season, provide a great return solution for them and their customers. And now that we're on the other side of holiday, we're actually catching up and taking a deep breath and exploring product synergies to kind of bring some of the best fintech offerings that Affirm, best-in-class fintech offerings that Affirm has, alongside our vision to build Loop into the best commerce operations platform in the world. And we're kind of just getting down to figuring out product synergies, but 2024 is a really exciting year ahead for us now that we've kind of first things first taken care of our merchants and their customers.
Jonathan, thanks so much. Appreciate it.
Yep, likewise. Appreciate you, Julie. Josh, thanks so much.
Coming up, we're going around the horn and checking in on some of today's top trending stories, including Steamboat Willie entering public domain and what that might mean for the House of Mouse. Stick around. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. Welcome back to the Yahoo Finance Group Chat. I'm Josh Schaefer alongside Praz Subramanian and Brooke DePalma. And our first story we're taking a look at today, are you looking to buy a house in 2024? Well, the secret to affording one may be moving back in with your parents. Yikes. According to the National Association of Realtors, 23% of first-time home buyers moved straight into their new home from a family member's home in 2023. Guys, a pretty eye-popping number there, and it really just brings to mind to me several of the things we've been watching in the housing market, right? You think of mortgage rates. Mortgage rates hit almost 8% last year, really soaring, the highest rates we've seen in over 20 years. And to think about what kind of impact is that having, right? So rates are this high, what's that actually doing? And when you take a look at different graphs on mortgage rates too, when you look at the people that actually, where mortgage rates are at versus what mortgages people are actually paying, significantly lower, meaning a lot of people aren't actually coming to market and paying. That's that graph right there. You can see in blue is what the rate was. In purple is the average that people are paying, so nearly half, meaning most people aren't coming to market. The question is, to not have to pay that 8%, are you really willing to live at home, Brooke?
Yeah, I mean, you think about this. This is no longer just an idea, just a concept. I feel like this is a tactical strategy that first-time home buyers are using. We saw last year roughly 23% of first-time home buyers moved in with a friend or a family member. The year before that, it was 27%. And so really, we're seeing a quarter of the population using this sort of strategy where they're moving in with a loved one, moving with a friend, a family to really save on rent. Right now, we're seeing these record rent prices, and it's really taking away that ability to save, in my perspective. Would I be willing to do it? Did it during the pandemic. Would I do it again? Love you, Mom. Not sure.
Yeah, right. So rent's out of control, costs out of control, student loan payments, rent high in major cities. But when we first started talking about this segment, you guys were mentioning to me actual anecdotal stories of people that are moving in. That's what I want to hear about.
A lot of friends, a lot of family.
But also people that are going to get married soon, right?
Yes.
Yeah. So I have one friend that was living in the city, and then him and his fiance actually moved out of the city to move back into homes for a year. You take that, whatever couple $1,000s you might be paying in rent in some of the big cities in America, put that into a savings account every month, and then you get closer to a down payment, right? It's crazy, There was a great article in the Washington Post pointing this out too. Really, the problem is paying the rent takes up so much of your income that you just can't save for the house. Like, yes, houses are expensive, but it's the inability to save, I think, while you're renting that a lot of people are renting.
And some families, on an anecdotal note, some families have a rental space in their home, and they're like, hey, I'll move out the tenant, I'll move you two in, you pay me a lower price than maybe you'd find in this market that's very competitive. In New York, we're talking upwards of $4,000 for rent. And so parents, loved ones charging a little bit less. Exactly, for one bedroom, parents, loved ones charging a little bit less. And then it all works out. They're able to save up for a nearly roughly $420,000 home. That's the current average right now.
I just feel like we're going backwards, right? Like it's like old school, like old Europe where like people live with their parents till they finally get married. That's what's happening in this country.
Right. Work from home definitely changes it too, right? Because then you're able to actually probably work from that place, and I think that's sort of a different dynamic post-pandemic too.
Well, one thing that you can't share anymore, and it's streaming services. Folks are increasingly cutting back on streaming service. That's according to subscription analytics provider Antenna. Now, about a quarter of subscribers have canceled at least 3 services in the past 2 years. Now, that's up from 15% 2 years ago, and consumers really being a bit more choiceful in this sort of environment about what they're subscribing to, just how much they're subscribing to, and certainly after the writer's strike, after the actor's strike, really being definitely choiceful about what am I actually watching and how much new content is being offered here.
I think, Brooke, you sort of alluded to the password sharing thing too,
Right.
and we just got through the holidays. I don't know if you guys had these conversations too, maybe some people you used to share passwords with, but that was a popular conversation I found this year at holidays among different parts of the family, people just talking about, I never really use that service anyway, or like, what one am I gonna get? I think is a hot topic right now, like what you're actually streaming. Right now, I think the biggest thing is it's very easy to opt out of these streaming services and opt back in. At what point are they gonna start charging you more to opt back in? Right now, it's I like a show, I'm gonna be on that service for 3 months, and then if you're adept to it, you just opt out, right? And then you opt back in when the season comes back. I think that's sort of what maybe stops some of the churn is you start charging it like a gym where you pay that initial fee and then you kind of want to stay in.
Right, or they get used to the churn if they're okay with that, right? But I was looking at it to the point that I used to kind of own all of the services. And now when
they were much more affordable at the time.
Right. And then
when you shared some.
Right, and then you see Amazon Prime going to insert ads into my prior to this non-ad service. I got to pay more for that. I don't want to do that. So I think that it's not going to come down to me or people in general picking like 2 or 3 that they want that are the most important to them. They have to have the killer IP that I need or whoever that they need, and that's all you're going to get. And you're going to live without the Hulus or the Maxes or Paramount Pluses. But that's the tough choice that I think consumers have to make now: is what's the bundle you're going to use?
Right. Yeah. Well, we're flashing all these logos and these prices, right? And immediately when you look at that in your head, I'm looking at Paramount Plus. What do I get? Well, I do get sports. I get pretty good original streaming, right? You get some very popular original shows. Then you look at the one next to it with the Discovery Plus. You don't get live sports or really access to live news or things like that. And then you could argue, original content, I think everyone could sort of argue what you get. But to me, sometimes it's just the diversity that you can get from some of the bundles versus other ones you can't. It's probably why you're seeing someone like Netflix maybe want to get into sports, right? So you have kind of a full offering with it.
And what I've noticed too with those price points is that many of them changed in the latter part of 2023. And now for my Max, I'm getting charged $15.99, but I never even got the option to opt into a with ad subscription. I believe it's only around $9.99. And so now's the beginning
of 2024.
They don't want you to opt down,
Brooke.
I know, exactly.
You only get the email to get sold up.
Exactly. But when you think about it this way, now's the time to really give consumers the opportunity to rebalance where they're looking. I'm sure we'll see this reflected maybe in Q2 during streaming services, really doubling down on budgeting. So I might be opting for that ads one. Sorry.
Well, I'm not going to do that. But I am looking for new content. But how about a horror version of, get this, Steamboat Willie, Disney's Steamboat Willie, coming off copyright here. The original Mickey Mouse cartoon officially ending its copyright run here after Disney's tried several times to push that copyright expiration date. They've lobbied successfully 2 different acts before 1976 and I think in the 1980s or 90s, able to push Steamboat Willie. I mean, this thing came out in like 1928. I mean, this is like old school stuff. But anyway, we're seeing new content creators come on board and say, hey, I want to capitalize on the fame of that old school Mickey and make this horror movie, which is kind of strange. I don't know if you guys are going to see something like that.
There's a few different iterations that are coming out. It's like 2 different horror movies. There's a video game.
I think the big question is, for Disney, has a lot of older IP coming off the books. Is that a concern for them?
You would think to some extent it is, just because a place like Disney is usually pretty good at controlling the brand and the messaging around characters, right? In what world would Disney ever make a Mickey Mouse movie that has a character that looks like Mickey Mouse, right? He won't be allowed to be called Mickey Mouse.
Steamboat Willie,
in the movie, it'll be Steamboat Willie. But Disney would never have that in a horror film context. So you just wonder how many characters does that
just play it over and over. You can play it as much as you want.
I mean, but how many times does that happen is the biggest concern. No way I'm seeing the movie.
No way? I honestly don't like horror movies.
The Winnie the Pooh horror movie. We don't need that movie. As a consumer, I just don't need it.
But it's important to note too, Disney saying that Mickey Mouse will continue to play a leading role here, and the current iteration of Mickey Mouse is unaffected. So therefore, they'll continue to be able to use it. And they did say that they will make it very clear that Disney is not endorsing these horror films, these video games that uses this Steamboat Willie. But other characters that are along with this 95-year contract expiring include the original Minnie Mouse, Tiger, and J.M. Barrie's Peter Pan. So a few others to keep a lookout for potential other iterations that could come this year, next year, as really Hollywood ramps back up production.
I will say, I think it's smart to go horror because that genre always sells. It always does well. People always want horror.
Like a good parody.
Yeah, parody is good, but horror, for some reason, the genre you can just go to a film festival with the film, Josh, and you can sell it in one day.
Right.
They'll buy
just
it.
not for me.
Yeah, not for you.
Not for me.
But hey, you know what? You capitalize. Horror genre with this old stuff, it all works. Anyway, coming up, what to watch tomorrow, we break down the stories you need to know to start your day.
It's a new year, which often means resolutions. And today we're talking about a fresh start for your finances. Joining us now, Wells Fargo Senior Director of Advice, Emily Irwin. Emily, thanks for being here. So as we look at the new year, as we turn the page, what's your top tip for people in terms of making financial resolutions?
Thanks for having me and Happy New Year. So we're going into the new year, understand what your cash flow is and make a budget. That is the most important thing for everyone to do this time of the year. It's especially important because now we have all the data from last year that we can look back at and use to our advantage to be able to think about what seasonally type of spending behaviors we have.
And Emily, you also say folks should consider a dry January when it comes to their personal finances. What did you mean by that, Emily?
Definitely. So many of us think about our physical and mental health this time of the year. Make a resolution to put your financial health in that same bucket. When you think about dry January, that really means take a step back and only spend on necessities. It's going to be maybe a little bit difficult, but a good exercise to go through. Things like gas, rent, mortgage payments, anything related to healthcare. Yes, spend those dollars. Anything that's discretionary, though, take a little pause for the next 30 days and see if you even really miss those items.
What is the biggest mistake that people make in general? I mean, I know that's a big question, and people can make all kinds of mistakes depending on their finances. But what's the sort of lowest hanging fruit, if you will, that people can correct?
I think most people think that lots of their spending is one-off and therefore they're not prepared for it. A perfect example of this is actually holiday spending, which we are experiencing and which consumers are going to be receiving their credit card bills for, if not now, in the next few weeks. What people don't understand is they think, oh, that's a one time of the year thing. But what they really mean is every year I know I'm going to spend, for example, $1,300 a year in the holiday spending. I can actually set aside $25 a month and fund that. And we have so many examples, whether it's health insurance premiums, auto premiums, holiday spending, or even that one vacation you take every single year. That's not a one-off. That's built into your budget.
You also say, Emily, to pay your future self by saving for retirement. For those viewers who are listening right now, Emily, what are the smart ways to do that?
Well, definitely, if you have an employer available plan available to you for retirement, such as a 401k, be sure to check, are you automatically enrolled? If not, and you have the wherewithal and financial ability to do so, enroll in that plan and certainly try to get up to that employer match. That is free money. No one's ever turned back a paycheck. Let's not turn back future retirement dollars as well. Secondly, you want to make sure if you're age 50 or older that you're taking advantage, if possible, of the additional funds that you can set aside in either a 401k or an IRA. Congratulations, you don't even need to be 50. You just need to be turning 50 this year or over that age as well.
Emily, we talked about your title as being head of advice, and I'm so curious about how people take advice and whether they take advice, right? I think probably for many of your tips, people turn to you perhaps when they're already in sort of dire financial straits. So how do you get people to be more receptive more early before it gets to that point?
Yeah, that's a really astute point. And the one thing I'll say is, to the extent you can do two things. One, think about incremental changes that are truly, you have the ability to implement and don't seem like the world is on top of your shoulders, kind of taking out that stress. That's number one. And number two, really thinking about how can you analyze the data to make it clear to someone that they have options and that Path A may take you 6 months to pay off your bills, but here's what you need to do it. Path B, you might take 12 months to pay off your bills, and here's the costs associated with it. But here are the behavioral changes you may or may not need to make in order to reach that goal. Being able to put numbers in front of someone and give them options, I think, is really, really important. So this is where getting like a year-end summary is critical. Maybe taking a holistic view of all of your finances, laying out all your credit card statements, all of your savings, putting it in an Excel spreadsheet, and really understanding the cash inflows and outflows and saying, where can I make micro behavioral changes that will really affect, a target payment date moving from, say, December of this year to June of this year. That's a big deal.
Emily, thank you so much for joining us today. Some smart tips and tricks there for viewers to consider.
Thanks.
Time now for What to Watch Wednesday, January 3rd, starting with the Fed. Federal Reserve Bank of Richmond President Tom Barkin speaking tomorrow in North Carolina, giving us our first economic outlook from the Fed in 2024. And that coming ahead of the minutes from the Fed's December meeting, which are due out at 2 p.m. Eastern. We'll also be getting a look at the labor market, the latest U.S. job openings data for November from the Bureau of Labor Statistics coming out tomorrow morning. We're expecting to see a slight uptick from October's number, which was the lowest number of job openings seen during a month since March 2021. And moving over to the earnings front, Cal-Maine Foods reporting second quarter earnings for 2024. That's after the bell. The egg-producing giant looking to bounce back from a bird flu outbreak at one of its facilities last month.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Hope you're having a great start to 2024.